Hey, everybody, and welcome back to another episode. I'm your host, Brandon Cobb, co founder of HBG Capital. And today I've got Zach on the show. Zach is the founder and CEO of Rent to Retirement, a leading turnkey investment company. Dude, this guy, he's a seasoned real estate investor. He's a licensed broker. He's got a diverse portfolio. He's done single family, multifamily, commercial, new construction projects. And get this, he's a licensed optometrist. He now volunteers to mainly use his license. He's not like practicing, but he's still licensed, him and his wife. He began investing in real estate while serving as an optometrist and a captain in the U.S. Air Force. And today we're going to talk about his story on how he was able to replace his income as a doctor with income from real estate and make that big switch. Zach, welcome to the show.
Hey, Brandon, I'm excited to be here. Thank you for the very nice intro. And yeah, excited to get into it.
We're going to get into some exciting stuff today. I want to know how you replaced your income as a doctor with income from real estate in your 30s, which ultimately led to financial freedom. I know a lot of people are seeking that, how you've done so many different asset classes. It sounds like you're really focused on build to rent, something that I know a lot about, and I want to dive into that with you and how you're getting some of this stuff to pencil and where you're seeing the opportunity. Before we dive into all that, what's your story?
Yeah, absolutely. And again, thank you for having me on. So, I mean, like most people, Brandon, I think that we're interested in real estate. Maybe they read some books, the Kiyosaki saga, whatever the case is. I just wanted to early on, and even when I was in college, I just wanted to be smart with my money. And so I looked at all the different ways to invest. I naturally migrated towards real estate. It was just really simple, right? The idea of taking out a loan. And actually, my first house I bought was a house hack, a duplex, lived in half, rented out the other half, and lived for free. And just the concept just really stuck with me because it was tangible and it was a real asset class that I could kind of wrap my head around. And that's kind of the journey. So, as a young captain in the Air Force, fresh out of college, I was, as I mentioned, commissioned to the Air Force as a captain to practice optometry. I was on scholarship. So, went straight into the Air Force, had access to a VA loan, which is great. No money down to buy a primary residence. I decided to buy a duplex. As I mentioned, rented out half, lived in the other half, lived for free. And I thought, man, what a great concept where I can borrow someone else's money, i.e., the bank, to buy an asset that I can live in and live for free, but I can also earn income on it, renting out the second unit. From there, my wife and I were like, this is a cool concept. Let's buy more, right? So the next year, and this was probably about 15 years ago, the next year I bought another duplex and then another. And I always tell people, since we bought that first duplex that we lived in, we've never taken a single year off from investing. And that's really what ultimately allowed us to build a portfolio that replaced our active income. Now, I'm not saying it was easy. It didn't happen overnight. There's a lot of deals that we lost money on, but we stayed the course. We believed in real estate and really continued to invest. But there was a pivotal moment that changed the trajectory of our lives and our business. And that's where we decided to focus on investing in other markets than where we were currently located. At the time, I was stationed in Grand Forks, North Dakota. It was not a great investment market. It was okay for cash flow, but not an area that you think, wow, what a growing market, North Dakota, right? So we invested locally to start, but then we started to strategically look at different markets throughout the United States where we saw better opportunity. There was more affordability, there was better cash flow numbers, certainly better appreciation in some of these growth markets. And so figuring out a system and a process to invest strategically out of state where we found the best returns and the deals that were most conducive to our goals, that like catapulted our investing trajectory and allowed us to eventually retire from our career path in optometry, which, as you mentioned, we still practice on a volunteer basis. But ultimately, that led to the foundation of our turnkey company, Rent to Retirement, because we were simply helping other people do the same thing that we did. And now our company focuses mainly on new construction because we love new construction as an asset, certainly in areas that have an undersupply of housing to allow for more growth. But yeah, that's kind of the quick and dirty.
I want to spend some time on this journey and put some context to it. I'm going to give this some teeth here because that's what everybody's interested in. How can I replace my active income where my investments pay my living expenses? So let's talk about that. You've done it, right? You did it in your 30s. What did that look like? You're working as an optometrist, you and your wife, and you said you mentioned you started buying duplexes. What was the magic number? What did y'all needed to hit in monthly passive income? And then walk us through the Lego building that it took to get here. Like, for example, what's the story behind when you bought these duplexes? How much duplex do you think added? How much did it add to like that monthly income? Because I'm curious what the building blocks looked like here to get to that monthly number that you needed to hit? What assets
Yeah.
you bought?
Yeah, I'd like to break it down for you. And it wasn't just duplexes. Actually, the majority of what we bought was just single family residencies that were just pure rentals, but we mixed in a few small multifamily in there as well. And then, continued to scale that over time in 1031 exchange. And that allowed us to, get that exponential growth. But early on, I mean, I never had the intention of not working in the career path. I had just spent, close to $500,000 going to school to get a doctorate degree to practice optometry in a career path that I love, by the way. It's funny, people ask me today, like, oh, or they have the comment like, oh, I'm glad that you found your passion or you found that optometry wasn't right for you or what. That was never the case. I always remind them, like, I'm very passionate about helping people see, and we have international humanitarian missions that we're able to like have a bigger impact on now. But to answer your question, the first goal that we had was, like $3,000 a month in passive income. Passive
Okay.
is a relative term because we were actively managing our rentals at the time, but
Right.
that's about, and we were able to accomplish that with just a handful of properties, like 4 or 5 rental properties. So probably within the first 3 years of investing, we were able to accomplish that. No secret sauce, nothing special about that. Putting 20% down to 25% down, using normal financing on just investment properties that cash flowed, and then continue to do that. And as I mentioned, investing out of state helped us, catapult that and really expedite the goal. But I never had the intention to be where I'm at today, and I think that's really important for the audience to listen to because some people have the goal of like, yeah, like I want to replace my income, I want to own 100 doors, I want to have $1 million passive income, whatever the case is. But there's many people that are just they just want to own assets that they believe in. They want to diversify their portfolio. Maybe that's not the right path for them. Maybe they just want to own a handful of rentals. And there's absolutely nothing wrong with that, right? I think so many people get on some of these podcasts and say, you got to like retire early and do all these things. And some people just don't see that as their path. But, our first goal, when we talk about financial freedom, there's different tiers that I kind of reflect back on now. The first is, yeah, let me cover my living expenses, right? The next would maybe be replace your active income. So we were able to accomplish that probably in year 7 or 8. And this is a dual family household, both professional careers, so we were earning 6 figures at the time, and we were able to replace that within a short period of time of just staying consistent to investing in real estate that cash flowed well and reinvesting our equity and our cash flow and things like this. And then the third tier of financial independence, in my opinion, really is like true financial freedom, where you're actually able to well exceed what you would earn in your W-2, and really like have a change your lifestyle to some degree and create generational wealth. And that's the point that we've reached now over 15 years of investing and building a business in real estate. But my point is that I never even had the intention to cover my expenses. I just wanted to be smart with my money. I liked real estate. I had a lot of obstacles, but I stayed consistent to investing. And that just naturally happened over time, especially as I became a more savvy investor and understood the tax benefits and leverage and how to compound all these things, because you really can get pretty far ahead in a short period of time by doing all those things.
Okay, so your first goal was $3,000 a month. What did the portfolio look like? Because a lot of people get into single family rentals, they own them, and then they realize that after accounting for capex, maintenance, unexpected fees, vacancies, they're only cash flowing like 100, 200, $300 a month. I mean, they really don't make a lot of money. It's a lot. It's a great equity builder, is what a lot of people call it. So, what did your portfolio look like when you hit that $3,000 per month first goal?
Yeah, so we were probably 4 or 5 assets within the first 3 years. And granted,
Okay.
we self-managed, so it was an active job.
Right.
These we weren't buying really, we weren't flipping houses, we weren't burning them, we weren't rehabbing them. Like we were buying generally decent asset classes that we didn't have to put a lot of money into. We put a good amount of money down, which also, that kind of slowed our buying. But that's about what the portfolio looked like then. But to your point, like, yes, I think most people, we really are big proponents of buying residential real estate, especially single family, small multifamily to start. Most people want to scale, and you get some economies of scale getting into larger asset classes or investing in a fund or something like that to, grow their portfolio. But there's, kind of this transition time where it's like, okay, yes, single family residency, small duplexes, whatever, they're great equity builders, just letting real estate do what it does, where you may not have significant cash flow. You should have some over the first 3 to 5 years, call it. But one day you'll wake up and look at all the equity you have and realize like, oh, I have a few $100,000 of equity that I can go in and cash in on that, whether you sell in 1031, whether you know,
Right.
cash out refi, whatever the case is, where all of a sudden you can double or triple your portfolio by just reinvesting your equity, which your cash flow goes dramatically up when you do those type of things. So, you know, those are some of the things we did, as well as focusing on, well, like we do now, new construction where you have less variability, less maintenance, because we certainly learned that the hard way early on.
Yeah. So what did the portfolio look like though? You said you own four assets. Were those four duplexes, four single family homes? Were they multifamily properties? Like how many units was that?
You're asking me to go way back. I think I
I
remember the
know.
first one and the second one. After that, it gets a little fuzzy, but I think we owned three or four single family. We still had the primary residence at that point, which we had moved out of.
Right.
And that was a pure rental that cash flowed at least 1,200 to 1,500 bucks a month after we moved out of
Okay.
that on a VA loan with no money down. We bought another duplex as a primary residence and did the same thing there. We had two VA loans. Some people think you can't have multiple VA loans. You absolutely can. We ended up selling that first duplex, not paying any capital gains because we lived in it. We sold it in
Yeah.
5 years. We lived in it 2 of the past 5 years. And we were able to reinvest all of that equity. But yeah, early on, I mean, four to five doors to reach that $3,000 a month income level, self-managing.
Self-managing sits at. It's not completely passive. Like, okay, so we've got 3,000 bucks a month. That's first goal. Looks like each one of those, if you've got four assets, is spitting off somewhere around 800 bucks a month in passive income, which is definitely doable. Sounds like you guys were doing some house hacking too, living in one side, renting out the other, no mortgage payment. You were getting your expenses down really, really low. Big fan of that. Okay, next step. What did the next step? What did the portfolio? How did it evolve, and what did it look like? What did you add to it to get to, the financial freedom where, your bills were just completely paid off and you're like, hey, look, we have replaced our doctor income with real estate now? Because I know I'm trying to like give somebody some context on what this looks like, because people see it as this goal that's super far away that they can't get to. And if you give it some context and you can actually see it, then it becomes a lot more real for a lot of people.
Certainly. Yeah. I think it was around year 6 or 7 that we reached the $100,000 income level from our investments only. That's net income. But how we got there was, making the transition to start investing out of state in areas where there was better growth potential, really.
Mm-hmm.
And this is where I started to learn about being a sophisticated investor with things like accelerated depreciation and, doing some of these things that really allowed us to be strategic in our tax strategy and growth strategy. A lot of those early assets that I bought had grown in equity at whatever 5 to 10% per year, pretty standard growth on most assets. Some of them did much better. We sometimes call those the lottery ticket properties, where it's just an average rental, and then 5 to 10 years later, it's worth like 3x what you bought it for, and you didn't plan that. But that's just a beautiful thing about real estate. You have to buy it to realize some of those. But we went through, I guess, our first round of 1031 exchanges, where we would sell off some of the assets because everyone's limited by the amount of capital they have to invest, right? You'll run out of down payments if you're doing the traditional route of 20, 25% down on assets. And that's okay. That's normal, right? But at some point, you got to reinvest your equity. So we had grown equity through those first properties. I think our first round, we had like 250,000 in equity. We did a 1031 exchange, so we didn't have to pay any capital gains on those. We reinvested them in more assets that cash flowed. And we specifically bought new construction assets in the Southeast. And this was really kind of the starting point for our business that we're running today, helping people do the same thing. But what we found is that in buying in growth markets, we can get a brand new construction house, similar price points, mid 200,000s. That's kind of the assets we were buying, in the low to mid 200,000 price points that were brand new construction in the Southeast, where we could get, I don't know, 6 to 8% cash on cash return, reasonable, but they were new construction assets where rents would go up dramatically year after year, and the homes appreciated very, very well. And so it's just kind of this buy, hold it, trade up, 1031 exchange. By the year 6 or 7, I think we probably, don't quote me on this, but I think we probably had 30 properties roughly at that point in time. Some of those were, I think we had a couple like mid-sized multifamily that we traded up into, and that's what got us to that $100,000 mark in net income. From there, and I'm happy to go elaborate, like the next level where we actually trade a lot of what we own now is commercial retail centers. We still have at least 40% of our portfolio in single family or small multifamily residential, because I'm just a strong believer in that, and
Yep.
focusing on the build to rent specifically. But, just kind of trading up into larger asset classes, bigger tax benefits that we were able to
Yeah.
reinvest our equity, active business, things like that.
So part one was the duplexes, single family, 3K a month, and then you utilize the equity from those 1031ing it, selling them to get the equity out to use that as a down payment on larger assets, these mid-sized multifamily. It sounds like this is kind of the second tier to be able to get your expenses paid, foregoing the taxes. You're getting all the benefits of 1031ing it. It's kind of like Monopoly. You're trading in your tiny houses for the large hotel at
That's
this
it.
point, same exact thing. And then from there, you're able to kind of continue to do the same thing where you're down doing like commercial retail strip centers. This is more of the generational wealth thing, like the game changer, the third tier that you're focused on. You're getting a lot of depreciation from that. So a lot of the income that you're making from all this is offset by the depreciation because you're investing in these commercial properties.
Yeah, that. And I mean, I would say if there's been the the biggest impact on our financial picture through real estate has really, because there's a handful of things that I think are key to do. One is just like getting started and staying consistent. Like those are just fundamental. You have to do those, even if you have deals that don't work out like you planned. That's life, that's investing, but you have to stay consistent. But when we really learned about the scalability aspect of being able to be tax efficient in our real estate growth, that made a tremendous difference. So yes, we went through the 1031 exchanges with those to buy larger assets. And we started to, now at this point, we're active investors, we're real estate professionals, coupling that with things like doing the bonus depreciation, the cost segregation studies, where not only are we offsetting all of our income from our properties, but we're actually able to save money that we from our active income, which we were still, at least my wife at that point was still partially working, her optometry career path. And so, there was a few years, 4 or 5 years, where our goal every year was buy enough real estate where we wiped out our entire tax liability from all income sources. That's money that then we could reinvest that we'd otherwise pay to Uncle Sam, that we could reinvest, buy more assets. That's more cash flow. That's more depreciation. And we got this really rapid snowball effect in growth. And that, I mean, that just really is like, again, that hockey stick growth where like you go from, truly passive income covering your active job to generational wealth. I mean, I think if you stay on that trajectory and you're a sophisticated investor paying attention to those things, like you can accomplish a lot within a decade or less of investing for sure.
Yeah, 100%. Let's talk about build to rent. Why build to rent? There's a lot of different assets out there. Why this one?
Some of the things we talked about, I mean, early on, we realized that buying older properties while they were lower price points tended to have more variance in their
More headache.
performance. Yeah,
More
simply
headache.
simply put, a lot more headache. We like build to rent because you have a brand new built house. You really have limited maintenance on them. You'll have a builder warranty for the first few years. You have things like, foundational and structural warranty for up to 10 years. There's your capital expenditures, I mean, are extremely minimal or if non-existent for the first 8 to 10 years. You
Yeah.
still should budget for those if you're, planning to hold them forever. But I mean, again, I think most people don't hold properties for 10 years because you probably do what we did and sell them in 1031 exchange. But, you know, um, new construction, they're in growth markets. I think there's a huge deficit, and I know you know this, Brandon, but there's something like a deficit of like 7.2 million homes in the US, and there's an affordability crisis right now. So we're being very intentional in the markets where we focus on, where there's an undersupply of housing and the population is growing dramatically. And we're serving the need of society by providing housing solutions for people. We try to be below the $400,000 price point in most of our markets. So we do a lot in the Southeast markets like Texas, Florida, Alabama, Carolinas. I mean, these are areas where the population is moving to the Sun Belt, where there's better cost of living, more affordability, more favorable tax structures, both from an income standpoint, from a real estate standpoint, from a cost of living. There's landlord-friendly legislation. So focusing on new construction specifically, where we can just have better predictability. Our average occupancy time for new construction is 3.5 years. I mean, on some of the lower income properties we started with, we'd be lucky if a tenant stayed longer than a year or even at the year mark. You know what I
Yeah.
mean? And then we'd have to repair it. So it's just way more predictable. But owning new construction in growth markets in the affordability range, which is like, $200,000 to $400,000. That's kind of the sweet spot where you got a lot more runway upwards. I mean, those appreciate much better. They're more predictable income, and that I think just positions people for a better turnout long-term investing.
Yeah, I'm a big fan of BTR. We were very, very aggressive in pursuing this before rates rose, and it's been difficult to get stuff to pencil. So let's talk about the numbers. Let's talk about the numbers from a per unit cost standpoint. So you can do as many of these as you want. What are you acquiring the land for? What are your costs to develop the land? And then how much is the cost of the home typically? And then from there, let's look at what the rent's going to be. So I'm curious, like I'm gonna break it down. For example, like we've got oh, we had some townhomes we were building. We were all into the land. I think we bought it for 20 what was it, $20,000 per townhome unit, and then we spent 45 developing it a lot. So we're all in for the land for about 65. Cost to build those townhomes was about, I think there were 1,700 square foot townhomes, so it was about 100 and I want to say $190,000 to build them. So our all-in cost on those homes were 190 plus 65, so like in the 250s, 255, somewhere around there. What are you, and then the rent on those, I think was, I want to say like $2,000 a month, somewhere around those. So that's what like we're building and selling assets for to end consumers. What do your numbers look like for these BTR holds?
Just make sure I understand. What was the total all-in cost? You said about $2,000 a month in rent, but what was your all-in at the end of the day?
255, 255, throw some interest and stuff on there, maybe like 265.
Yeah, I wouldn't say that's far off actually from some of the numbers that we have. We can talk about the other things that matter as well, like real estate taxes, for example, that can be insurance costs, which there's a big insurance change happening in the U.S. right now, and a lot of people are concerned about what insurance is going to be, especially in markets like Florida and things like this. Our insurance numbers have not changed more than 12%, I would say, on any property because, again, new construction homes generally have more favorable insurance structures. The people that are really getting hammered are people where they're in flood zones. We don't build in flood zones. They're in flood zones where they're an older house. They're a higher risk to insure. And now all of a sudden their insurance costs have like tripled. So controlling some of those other variables, I think, is really important. Debt makes a huge difference. Construction debt is really challenging these days, and rates obviously are challenging for that. The market's a little bit slower, so there's additional hold costs that we need to factor in, from a building side. But our company does two things. We do a lot of ground up construction that we personally build and keep and sell to our investors, but we also partner with national builders that have excess inventory where we can come in and actually negotiate acquisitions from them like an institutional buyer would, because we're buying hundreds of houses at a time, and then pass those same cost savings on to the individual investor where they would not have access to that, to like go to a DR Horton. If you're John Doe off the street and you go to DR Horton, you want to buy two investment properties, you're going to be paying market value. Whereas, we can offer things sometimes 15 to 20% below market value because we're buying in bulk from national builders. So those are two different kind of business models to accomplish the same goal. With the stuff that we're building internally, we actually don't do a lot of land development. We buy from land developers, or we buy land that's already pre-parceled out, doing like infill lots. And so that reduces a lot of the development costs in those. I mean, we are picking up land, say it's like Southwest Florida, for example, $20,000 a lot that already had utilities, or if not, it's a septic well system. But I mean, it's affordability in land and infill where we don't have to go through the whole community development. I would say most of our products that we're seeing are in that 250 to 320 range in acquisition cost. And our rents are probably anywhere in the low 2,000s to sometimes upwards of $2,800 a month, depending. So if you're just putting a normal 20% down, even with where interest rates are at right now, you can still, carve out a 5 to 6% cash on cash return from a pure cash flow standpoint. But these are A-class areas that have strong appreciation. Our average rental increase year to year is 6%. That's double the national average because we're specifically investing in areas that have rental demand. But how we make it strategic for the investor, whether it's us buying in bulk from a national builder and offering, discounted prices, or us doing our own ground up construction, is we offer a lot of incentives right now. And we're not the only ones. I think a lot of builders are in this position right now because they have a little bit of excess inventory. where you can have a really good buying opportunity that you probably won't have in another 6 months from now. And I think
Yeah.
that's really important. To be specific, builders buying rates down. We're doing the same thing. We're buying rates down to 3.5%, 4% on a 30-year loan. We're paying all the points for you so you can actually cash flow well, and you don't have to go through the refinance as many people will in another year or two to lower the rate. That's one thing we're doing. We're offering up to 10% of cash back at closing in the price. So on a $300,000 build, we'll either reduce the price by 10%, that's $30,000, or give that money back to you immediately. That's where you can have half of your down payment covered. We also have creative lenders like credit unions, local credit unions, that will finance up to 95% on up to 5 investment properties. These are pure investor loans where you can put 5% down. So there's a lot of creative things in addition to just the normal numbers on a property that can make it a better investment than, say, maybe a different part of the market, or, the different part of the country or whatever.
So it sounds like you're utilizing a plethora of exits that are available to you. When I hear BTR, usually that means three things. There's three exits people usually line up. Number one is they'll build the whole community and usually contract with a build to rent fund that buys it. And so this BTR fund will buy your whole development from you, so you can just literally build it, just sell it to the fund, and they can hold it. Two is you can hold it yourself forever and refinance out once you've got enough equity accumulation to get the investors out of the deal. And then the third is you can build it, and then you can sell off a lot of these individual properties to individual investors. Which one are y'all utilizing? And if you're utilizing multiple, do you have one that you prefer?
I mean, we always keep the individual investor in the back of our head, right? I mean, a lot of these build to rent builders will sell to institutional buyers, where they're specifically building a build to rent community for an institutional buyer, and that's their goal. And so they have to meet a lot of their metrics. We reverse engineer our business model to keep the individual investor in mind. So this would be someone, and this is our main exit strategy. We do keep, probably 20% of what we do to continue our own portfolio, because we believe in what we're doing. But we obviously don't have the capability financially to keep everything, right? So a majority of what we're selling off is to the individual investor. This is someone who, people who are attracted to the turnkey model of investing. These are people that are either a brand new investor, they need a little bit of hand holding, they want to own physical real estate. Maybe they're an active professional with their W-2. They don't want to be their own landlord, especially if it's out of state, a distance. They don't want to buy themselves their job managing property. People that live in expensive markets and their local real estate is non-accessible. I mean, a lot of the same people I think that you probably serve as well with your community. So those are mainly the people that we're serving. So we always want to keep them in mind. We want to have, positive cash flow, anywhere from that, 5 to 8% cash on cash return. We want to be in the areas that have growth, where they can have appreciation both on rents and home prices, where there's affordability metrics, where there's low taxes, landlord-friendly legislation. All these things are really important to understand. What is the sustainability of this investment long term? But that's pretty much our core exit. And we know that, if we sell, I don't know, we'll do probably 900 doors this year to our investors. So we can kind of reverse engineer the demand. So if we have, if we're selling 60 houses to 70 houses a month, we know that, that's about how many we need to produce in that period of time. But we also have access, like I said, to some of these national builders where we're actually helping them with their disposition as well, as they're sitting on more inventory than they normally do, and trying to be really creative on the financing side and the incentive side to make a deal make sense for the investor based on what they're trying to accomplish.
Yeah, I love it, man. Very powerful strategy. I'm telling you, this is one of the best vehicles out there for depreciation, tax benefits, owning something new versus something old that doesn't have as much headache. Whether you want to, buy one of Zach's properties and own it outright, from him because they can negotiate better terms than what you can because they're buying these things in bulk from these national home builders. Or if it's participating in one of his funds or syndications where you can be an active, owner in the whole community, it's hands down one of the best things you can do. Zach, if people want to learn more about you, learn more about your offerings, where can they go?
We always want to drive people to our website. That's renttoretirement.com, renttoretirement.com. We have our own podcast that we put out a ton of information about just market data, build to rent, just, investment, different loan structures. So whether you're investing with us or not, ton of resources there. Our YouTube channel is blowing up. We have over 100,000 subscribers. So just go to the website, check out all of our information. If you're listening in the car, you can also text REI to 33777. If you're interested to talk about turnkey build to rent properties, investing with us, one of our investment strategists can get on, talk about your goals, your strategy, see if this is the right fit for you. At the very least, share some additional resources with you. So we'd love to speak with anyone that's interested.
I love it. We'll make sure that gets shared in the show notes. That was REI to 33777. If I'm not mistaken there.
You got it.
Zach, it's been a pleasure having you on the show.
Brandon, thanks so much for having me.
Hey, and if you're getting value from this, show Zach some love, show me some love, subscribe, share this with your friends and family. We will see you guys next time.